Good morning, traders. It's 8:01 a.m. on Thursday, the 11th of February, 2016. Thanks for joining. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. Lots to look at overnight. Looking at the overnight sentiment, oil is down 2.6% to new lows. Gold is up 3.25%. U.S. Treasury bond futures up 1.31%. 10-year futures up 0.67%. The German Bund is up 0.5%. So that combination there shows capital flow out of risk-related instruments and commodities to protection. Asian markets, the Nikkei down 2.3%. The Hang Seng got hit by a whopping 3.85% drop. Shanghai is closed. The Japanese yen is up 1.04%. Again, more of a defensive position. The Eurozone equities, FTSE, 0.69%. Oh, sorry about that. That's not up to date. U.S. equities, the S&P futures down 1.65%. U.S. dollar index is down 0.26. Let me look at what we have here for Europe. So in Europe, the DAX is down about 2.2%. The FTSE is down 1.9%, and the CAC again gets hit with a drop of 3.29%. Bank stocks across Europe are down 3%. That's really leading the charge. Down, Spain's IBEX is down 3.8%. That is the loss leader in Europe. Sweden's central bank dropped its rates to now around negative 0.5%. As I said, gold is surging. Gold has gained about 17% since its six-year low, since it hit its six-year low of 1,051 an ounce in December 17th. So imagine that rise over the last month and a half or so. Twitter announced yesterday, came in at 16 cents a share on revenue of 710 million. Tesla missed big time, but the stock is still holding steady. For today, we did get initial claims this morning. Initial claims were reported at 269,000 versus 280,000, so a fair amount better. Continuing claims 2.239 versus 2.25, slightly better. The Japanese government says that it's not going to comment on whether or not it had intervened into its currency overnight. I find that very interesting that they're not actually saying what they have done with their currency. Other than that, let's take a look at what we did yesterday. Yesterday was a very interesting day. Things played out pretty well. So the primary hypothesis for yesterday, if you recall, was for it to open and to likely test down into, let's change this to yellow and normal. The expectation is the market's likely to test down towards the 1848 quarter, potential initial support at the value high area of 1851. And what it did is it dropped a little bit and then it moved away and started to move towards the 1818 NVPOC. Our first target was 1865 to the long side. We expected a reaction there, and then eventually I was looking for it to go to 1890. I said for the week over the next couple of sessions because it did not have the range. It's not likely to have the range to push to there in this particular session. What it did was it did test down, then it pushed through the 1865. And it got to 1877.75, just short of 1880 point of control from back on the 5th Um, and it found these sellers. You could see there's an excess high here on the 15 minute and a very sharp taper in volume. This is a pretty strong high on the session. Rotates down and immediately puts in a neutral day. So it has broken the IB high and the IB low with just about an hour's difference. Then it crosses to the other side and takes out the IB high again, and then ultimately drops down into the prior day's point of control and puts in um, a very sharp high volume node right against the prior day's point of control. Very, very embattled day. As I said, we're likely to have pretty wide swings on the open yesterday, and we did. There's just a lot of interest from both sides to step in. Value had moved higher from one day to the next. The point of control had moved higher. Value is up. Price action is up. So this looked like a reversal day, so there was a lot of incentive to find a base and to push higher, and that was the primary hypo. And it did accomplish that early, but it did find its sellers, and it ended up closing right up against the prior day's value. So even though we have a price action higher high, higher low, we do have a point of control that is higher. The overall fact is it finished neutral extreme down, and neutral extreme down is generally a marker for a reversal. We're looking for neutral extreme up like we had on January 20th. That day, that Wednesday, where it rallied 65 points, that was a neutral extreme up, and that was a reversal day. And I suggested you mark that day as a key reversal day, and that's what it was. That was from the 1804. Any push down, as I had been talking about over the last couple of days, any shift down is likely to target this 1810.75 between 1848 and down. The most valuable price is 1810.75, and we got through it overnight. We went to 1802.50. The overnight session, let's pull that up. The overnight session just had no relief from sellers at all. As soon as it opened right where it closed, and as soon as it opened, it just tracked downwards. And then we had a large drop, and then we had basically an impulse, pullback, continuation, and now we're in a consolidation, potentially corrective onto the upside. I'm looking at this using the overnight. I'm looking at this 1831 to 1832 area as potential initial resistance in line with 1843 to lean on, 1848 being the point of control above from the prior couple of days. So this is solidly bearish right now, but I'm watching this 1831 area as an over underline early on. We are opening in a gap down. We're opening in a gap down. So the expectation is that it's likely to try to continue and then try to find a responsive buyer back up. There's a relatively high probability today of an open drive. So as the market opens, it's really important to cut down your chart to a very, very short time frame, assuming you are a day trader. Obviously, this doesn't apply to a swing trader, but if you're a day trader, you want to you'll want to watch very carefully how it opens, what kind of an opening swing it puts in. Is it a two-way opening swing like we have here? And as soon as it drives, that becomes the part of the open that you want to pay attention to. But if we're in a gap, generally, if we're in a gap, say a gap above, we will have either an OAOR open and then the market responds, or we have an open test drive and then the market responds. It has a driving behavior, which means there's a higher time frame in here. You don't want to fade that. And then today, with it opening below, so let's go there. We are way down here. So you look at where we are versus where we finished yesterday. There's a high potential of an OAOR and a strong responsive behavior on the open. In either case, we're opening in a large gap, and what that says is there's an imbalance in how the market perceived value yesterday versus today. There's a huge incentive here when we have a gap like this, even though um, we are gapping away from the most recent balance. So the expectation is responsive. In other words, back to where we were. I don't see anything in the news that really clearly affects how the market should value might value the S&P, but overall, you're looking for what kind of behavior occurs at the open so we can identify that bigger time frame participant and so we can trade with that participant. So that's the big thing to pay attention to this morning. And that's really what I have for you. So the primary hypo for today, an open auction, out of range. I expect it to try lower, potentially down into that 1810 area, and then I expect that it's going to likely try to push back up into into and towards that 1831 overnight, and then into 1845 or so, 1848. That's the expectation this morning. If it fails to do so, then if it responds immediately and then gets choppy and then starts to rotate down through the midpoint at this point, then I'm looking for a pullback failure and then a push down to 1810. That would be hypo 2. And then a continuation lower. The fact that it's open down here 1817, the fact that the market has been sustainably trading in a pretty wide range. So the market has consistently, you see the first standard deviation of range is right down here, 23 and a quarter. And if I put a line at 23 and a quarter here, you can see all of these range bars that are above that. Pretty much every single day so far this year has traded, except for maybe two. Every single day has traded above one standard deviation. So in general, when we're plotting our day, we're looking at the 20 to 25 point range as the normal range that we have to plan our trading plan for, but we're trading more in the 30 point range, and the 30 point range down from the open, assuming it does not make any responsive attempt, puts us at 1790 or so, and opening, and then the range up puts us in that 1848 area or so. So that's what we have to plan for. Again, chop responsive is the primary hypothesis, chop an attempt and failure as a secondary hypothesis, and then we're looking for 1800 to be tackled all the way down to 1790 as the potential on the downside. Anyway, there's a lot to play with here, a lot going on in the market. Again, just pay attention to your risk. Do not get stubborn with positions. Don't let a position that has run away from your risk parameters to just continue to take away your account. I'm seeing that a lot these days, and it's very, very bothersome. It'll destroy your ability to sustain yourself as a trader. There isn't a single trade that is worth that much of your account. There just is not. Your goal is to take as many trades as possible. That's the only way your edge will show up. Your edge is not going to show up in one or two coin flips. It's going to show up over many, many, many coin flips. So the managing risk and keeping risk in check is the only way, in my opinion, for you to survive any kind of market condition and give yourself a chance to adapt over time. Good luck today, and I'll catch you tomorrow. Take care.